BQ Prime. You're watching Quarterly Earnings with BQ, and my guest today is Mr. M.V. Ramana, who is the CEO of Branded Business for India and Emerging Markets at Dr.Reddy's. Mr. Ramana, thank you very much for joining us on BQ Prime. Joining me is Monal Sambi, who is my colleague who tracks pharma very closely. To begin with, Mr. Ramana, can you take us through this non-operational income which has come in this quarter, and which are the brands that you have sold?
So we have sold few of the brands. So they're basically two transactions. One is with JB and other with Torrent. And that has led to a certain amount of recognition of the income that we have. Other than that, in terms of the other incomes that we have got, is the settlement that we've had in the US. And we've also got the benefit of the foreign exchange as well, the appreciation of the ruble, which actually has also given us the benefit. So that's been the other income this particular quarter.
What is the kind of revenue that you're getting from Russia?
So Russia, we continue to do well. What we had told you in the last quarter, that because of the conflict, there was a stocking up that happened both at the pharmacies as well as at the consumers or the patients level. We see that normalizing in Q1 of this particular quarter. We continue to track well. We continue to have a positive EI in that market. We see that many of the companies continue to ensure availability of their products. We continue to do the same in Russia.
Mona, you have any questions?
Yeah, so now that we're talking about niche markets, another market that is of great interest to all the investors is China. I mean, everybody's looking forward to it. So could you just highlight some plans that you have with China, and how do you believe this would be contributing to the revenues going ahead?
Sure. If you look into China, the non-linear change, I would say, in China has been the go-to-market change, where today there is a centralized purchasing system called GPO, which basically means that once you have a product that is registered, you could actually participate in the GPO. And if you are participating in the GPO for the first time, when it is called for that particular molecule, you get an additional benefit that in the second GPO, there would be a certain portion of the quantities reserved for the people who participated in the first GPO. So there is a benefit of high quality generics at affordable price. But if you are bringing it for the first time to the market, then you get an advantage of that. Initially, we had one olanzapine in terms of the first GPO, followed by the second GPO. In the latest GPO that took place, we won another product, abiraterone. So which basically means that today, you see that there is absolute clarity in terms of what it takes to register a product in China. But if an organization is willing to understand the requirements of the Chinese FDA and you are able to align your product, then depending on how fast you're able to get the registration, and if possible within the first wave of registrations, you actually get to participate in the first GPO.
So any timelines that we're looking at?
So if you take today, in terms of the filings, we have been constantly increasing our filings in China. Of course, as compared to the international generic companies, we are doing a good number of filings. However, if you do compare with the best of class Chinese companies, there is still a lot of room for us to improve. So we will continue to focus on the gold standards, the products that are required, the products that are essential for the Chinese market, and our endeavor would be to ensure that we get as many approvals and at the same time have the opportunity to participate in the GPOs.
So any targets, any revenue targets that we are aiming for from this new geography, or anything that could be shared?
So I think in my view, for China, because of the way in which we are structured, we do have two entities. The entity of the representative office is where we are focusing on getting both filing and getting approvals. And the more approvals you aggregate, the more would be the correlation of wins in the GPO and the revenue that would accrue to us. The second is our joint venture in China. There we do have products that are niche, that are essential. For example, we have a gout product, we have a product for dementia, we have a product in cardiology, and there we build direct to market capabilities to ensure that we continue to build the brand. I think both are required in China for you to have a sustainable growth. But that's the plan, that we will continue to look at bringing in more and more products to China. Another very important development that I do see, that with very specific conditions, the Chinese FDA has also given opportunity to bring in products which are registered in US and Europe, for which you don't necessarily need to repeat the bio. So it becomes another interesting opportunity for the generic companies, and we see this as a good opportunity for us.
So now if we were to break up the EBITDA and the performance this quarter, there was a line which said that, if we were to exclude these non-operating incomes, we are still at par in terms of sales. So could you kindly elaborate on that? Because the EBITDA margins have almost been in line as compared, like if we were to look at it year on year. So
yes, so EBITDA margin. So what has happened is we have, let us say, positives and negatives. On the positives was some of these other income benefits that we have got. If you take what we did not have in this quarter compared to the last quarter was the COVID portfolio. So pretty much absolutely no sales on COVID, whereas we did have a benefit of COVID portfolio both in India, in emerging markets, as far as API Plus is concerned. So if I see today, while we have reported a 6% growth, if I remove and account for some of the COVID portfolio and the normalization, our business continues to grow in the same way, both in terms of top line as well as EBITDA, as what we would have normally done.
And so how are we planning to propel this growth further? I mean, going ahead, since COVID might not really be in the picture anymore.
So if you see, our business has been a pretty diversified business, and we are today working to ensure that there is growth in the branded markets, whether it is India and emerging markets. And today, India and emerging markets, in terms of the market share, is quite meaningful, almost accounting for 40% of the total revenues. And then we do have a very important market in the form of US as well as Europe, which continue to also drive the growth with new product introductions. So because of this diversified business and our ability to leverage the portfolio, so whatever is the portfolio that we are developing for US and Europe, we're actually able to leverage it into the emerging markets as well as India. We feel that we are on track to continue to grow the business.
So
Mr. Ramana, what is the kind of headwinds that you see going into Q2 and Q3? Do you see supply side some constraints or raw material cost as some of the headwinds, and how are you managing that kind of headwind?
So I think if you see in terms of the headwinds, logistics cost or commodity prices have been some of the headwinds. Could also be in terms of forex, but we have hedged ourselves as far as the forex is concerned. And the only way that you would be able to manage the logistics cost or the escalation of the commodity prices is through productivity, both in terms of manufacturing as well as the front end. We have clear productivity ask of the team, and we will continue to focus on them.
What is the kind of product pipeline that we see for Q2 and Q3? There was some targets that we had set in the beginning of the year about product launches. Where are we on them?
So we are pretty much on target. We do expect about 25 product launches in the US. India should see about 30 product launches, and I think emerging markets, we should launch more than 100 products.
Monal?
So a little more on the markets again. So is it to be understood that the focus is now going to be more towards India and emerging markets?
So I think it would be both. India and emerging markets continue to drive double digits. US would be a high single digit in terms of how we see the growth play out. But we see a lot of synergy between the branded markets and the generic markets because we are uniquely placed in terms of our footprint, both in the developed and the developing markets. We feel that we will continue to grow in both the markets.
Sir, any divestment plans for the coming year as well, since we've been doing that consistently?
So what we have been doing specifically is how do we build a much more robust and meaningful portfolio for India. For example, in the last quarter, we have been able to see the benefit of the acquisition that we have done, the SIDMUS. In the area of CVAD, we're not in the top 10. There are portfolio gaps, and we felt SIDMUS is a very good product for congestive heart failure, and then we've been able to get access to it. And we've also been able to license in portfolio from Novartis, and you would see through the IQVIA, we have been able to grow both these portfolios handsomely. While we will do this, I think there would be some brands which are not where we would not be able to do justice. So those might be the ones that we would take it up, because this is one way how we would want to build a much more robust portfolio for India. Our aspiration for India to get into top 5 continues, and we feel that we need to have a winning portfolio in order to get there.
So a little bit on the divestment, sir.
That's what I said. So we do have an idea in terms of what are the mega brands that we would want to channel our resources, channel our efforts to continue to grow. We do have some brands which are on the periphery where we feel that we would not be able to drive the growth.
Okay. So if we were to look at growth and divide it by components, would it be more driven by, of course, the geographies that we mentioned above, and more acquisition-driven growth? Is that what we're looking at?
No, I think the growth primarily will continue to be in organic. Two, if you take today, you have in the branded markets, the big brands, we will continue to focus on them, both in RX and OTC. But at the same time, we do have institutional business, both in US, Europe, as well as emerging markets. And these are all global products. So it's a single development, but you're able to take it to many, many countries. So we would obviously be launching the products on the institutional side, and hence the growth will continue to be on how do we grow the mega brands, both in RX and OTC, and how will we continue to have a robust pipeline and launch meaningful products and leverage them across markets.
Mr. Ramana, if we have to look at the US market where you have a significant exposure, many of the players, including you, are facing pricing pressure there. Can you give us a sense of how that pricing pressure is now, or pricing now faring? What kind of strategy have we used to stabilize that? I know you were talking about introducing new products where price erosion is much lower, but how is this environment? Has it still remained the same, or has it improved a bit?
I think it has remained the same. What we see in the last year, we continue to see into the Q1 as well. I think this is how the market is. There are only two ways in which one could try and grow within this market. One is to continue to launch products, continue to launch meaningful products, and continue to work on operational efficiency. Both of them are what we are doing and will plan to do.
And you don't see this ebbing anytime soon?
I don't see that right now. I have not seen it in the last year. I have not seen it in the current quarter. Looks like it is the way in which the market is structured. I'm not able to speculate at what point of time this would actually go down.
What's the kind of pricing that you've seen in the European market? Is it mirroring what we are seeing in the US, or it's much better there in terms of pricing?
So there again, if you see in Europe, even in this quarter, we have continued to grow. I think the number of products that we are able to launch, but more importantly in Europe, we've been able to open up new markets. And all of these markets are product, so which basically means we're able to get a much more leverage. And thereby we see the growth, both in terms of new products as well as increasing presence in more European markets.
Mona?
And so just an update on biosimilars.
So biosimilars, the product that we had developed earlier, we have been able to take it into more markets. We have been able to launch the products in Latin American markets, namely Colombia. We have been able to get good traction for the products. We've also started to get registrations of products in Africa, both in terms of South Africa as well as North Africa, and we expect to launch them in these markets. While we do this, we have started our development, and you're aware that rituximab would be the first global biosimilar that we would be taking both into the developed markets, but also within the emerging markets, which requires a developed market dossier. We would be able to leverage those markets as well. We do have a pipeline, and all the products that we're developing now would be for the global markets, both for the developed and emerging markets.
So, sir, can you just give us some revenue targets for the biosimilars? Because so far, I think that's not disclosed.
Yeah, so we don't disclose segment-wise revenue targets. But if you see from a point of the biologics contribution to the global sales and the expectation from 2025 to 2030, it's going to be quite significant. And hence, I think as an organization, we want to participate in that and offer those products both for developed and the developing markets.
Sir, if you have to look at the margin pressure which you there this quarter, you had the cushion of sale of non-core brands for you. If you go into Q2, Q3, do you see margin pressure to be there and continue to be there given the kind of global dynamics which we are playing out in? And is there any other levers or there further non-core divestments there in the pipeline that may help in cushioning the margins?
So if you see this particular quarter, we have had, so when we remove the one-offs impact that we've had, whether it is in the form of Forex or whether it is in the form of lower sales leading to higher overheads, we do see them getting offset. So if I remove the one-offs, our margins, which normally is between 51 to 53%, is what I think we would be able to see going forward.
Mr. Ramana, I know it's been a pleasure talking to you today on quarterly earnings at BQ. Thank you very much for joining us on BQ Prime.
Thank you. Thank you.